Good afternoon and welcome back to the hearing involving docket number 2021-88E, Dominion Energy South Carolina Incorporated's 2021 avoided cost proceeding. Let's take a roll of the commissioners. Present in the hearing room, we have Commissioner Thomas, Commissioner Carolee Williams, Commissioner Powers, Commissioner Belser, and virtually we have Commissioner Irvin and Commissioner Caston. Mr. Goulding, are you with us?
Yes, I am.
Mr. Goulding is on the stand, and I believe we are now to recognize Pine Gate Renewables, LLC.
Hello, this is Bland Allman for Pine Gate. We have no questions. Thank you.
Thank you, Mr. Holman. South Carolina Coastal Conservation League, Southern Alliance for Clean Energy.
Yes, thank you, Madam Vice Chair. We do have some questions. Good afternoon, Mr. Goulding. My name is Emma Clancy, and I represent SACE and CCL. Thanks for being here today. Can you hear me clearly?
Yes, I can, Attorney Clancy.
Great. So I'd like to start with a few questions about LAI's avoided capacity recommendations. And to start, I'd just like to review the points that you and Mr. Searcy agreed on. If you wouldn't mind just going through a couple points with me.
Of course.
So first, LAI agreed with Mr. Searcy that Dominion's capital cost assumptions should be based on EIA data. Is that correct?
That's correct.
And LAI also agreed that a performance adjustment factor of 1.05 should be included in Dominion's avoided capacity rates. Is that correct?
Yes.
Okay. And the 1.05 number is consistent with the outage rates for the peaking plants used by both Duke and Dominion in their avoided capacity calculations. Is that correct?
Yes.
So it makes sense for both of these utilities to have the same PIF if they're using the same reference technology.
Yes.
And then you also agreed with Mr. Searcy that Dominion should make the single technology neutral avoided capacity rate available to solar QFs. Is that correct?
Yes.
And under the technology neutral capacity rate, resources regardless of type will be compensated depending on their ability to generate capacity in certain hours, correct?
Yes.
Okay, great. Now, with respect to seasonal capacity allocation, though, LAI's and Mr. Searcy's recommendations differed. LAI recommends that the Commission adopt Dominion's proposal to assign all capacity value to the winter months for the time being, whereas Mr. Searcy recommended that capacity value be allocated to both the winter and summer months in the current proceeding. Is that right? Is that your understanding?
Yes.
Okay. And in making its recommendation, LAI notes that the data shared by Dominion, and this is a quote, lacked information on peak demand or reserve margin trends for months other than December to February. Is that correct?
Yes.
Okay. So does that mean that the available data showed demand only in the winter months, so LAI couldn't compare Dominion's summer capacity needs with Dominion's asserted capacity needs?
So we ultimately came to the conclusion that the allocation to winter was consistent with the approach taken in the IRP. And so while we would have liked to have seen more information with regards to reserve margins in each of the periods, we felt that we had sufficient information to support the recommendation that we did while encouraging further information to be provided in subsequent proceedings.
Right, okay. But just to be clear, you didn't actually have access to that sort of peak demand data for the summer months, which is why you're recommending that analysis and that data be provided in future proceedings.
That's correct. To be fair to the company, we did not submit an IR on that, so the company didn't have an opportunity to respond. So I'm not necessarily suggesting that the company wouldn't have provided that information had we asked for it.
Okay. And so, but I guess based on LEI's recommendation to that Dominion assess the value of summer capacity and provide more clarity in these future proceedings, it doesn't sound like, based on the review you conducted, that Dominion did substantiate the absence of any summer capacity value. Does that make sense? So LEI wasn't able to substantiate the importance of summer capacity value, but Dominion also didn't substantiate the absence of any summer capacity value.
I think that's true, but I do want to again emphasize that we also looked at the IRP, and the IRP was a very fulsome process, and we felt that the recommendation was consistent with the IRP. So yes, we'd always like to have more information, but there's also, I think, a market design question that one needs to be aware of, which is if we go through and do the analysis and we see that the need is only in a particular period, then the question arises, well, should that period be the only period that pays for incremental capacity? In other words, is that incremental need caused only by that period, or does that capacity make a contribution to other periods? Now, the approach that Dominion has argued for and that we have supported for the purposes of this proceeding is that they've identified their need as being in winter, and they've taken the position that from a cost causation perspective, new capacity is driven by that winter peak. So if you accept that, and we have no evidence to believe that in future modeling, and it's important to note that what we care about is what we think is going to happen in the future as the system evolves, rather than we need to be aware of what's happened historically, but ultimately the modeling for the future is based on winter peaks, and the cost causation argument is that the winter peak is driving the need for new capacity, and so that, I think, logic is consistent with what DESC has proposed, and we felt that we had sufficient information to recommend that in this period, while also asserting that in future applications there should be more information about the summer.
Okay. Well, you did raise the IRP, so I just wanted to follow up on that point. So it sounds then like LEI did have a chance to review Dominion's most recent IRP?
Yes.
So then did you review Dominion's commission-approved plans to retire the Watery and Williams coal plants in 2028?
In the context of the IRP, yes, we haven't reviewed every single order or document associated with that. Right, and
those two units total approximately 1,300 megawatts of capacity.
Yes.
Is that your understanding? Okay.
Yes.
And so wouldn't you expect as we are looking out over the next 10 years, wouldn't you expect a retirement of that magnitude to create a capacity need during both the summer and winter seasons?
So I think it does depend on the amount of solar in the system and how you expect that to grow. I think that one of the challenges of looking at the future is thinking about all of the different possible scenarios that could occur, and to what extent to meet your reliability requirement, which of those scenarios are the most probable within the bounds of trying to meet your reliability. In other words, if you're only looking at something that is 90% probable, you're probably not going to build enough capacity because you know that there's going to be things that have a relatively low probability, but nonetheless are going to occur. There's going to be surprises. So in looking at the retirement of specific units, particularly the coal units, yes, we need to think about when that capacity is going to be needed, but in also thinking about when the solar is operating and how much solar is on the system, the amount of capacity that we're procuring is really driven by when is the peak going to be and how much higher is that than average load. There's a number of other factors that come into that. So the driver of system planning is always going to be when that peak occurs.
Mm-hmm.
That's not necessarily going to change. You can retire any amount of capacity. It's not going to necessarily change when the need for load occurs.
Okay. Well, did you review Dominion's own calculations, specifically the expansion plan used by Dominion to calculate avoided costs? It shows that the first year of avoidable capacity is 2028. Did you?
Yes.
Okay. And in preparing the LEI report, you also observed the prior evidentiary hearing, correct? Or reviewed the transcript?
You're talking about the transcripts specific to this proceeding?
Yes, yes.
Yes.
Okay, so do you recall Dominion witness Neely's testimony that if you take both of these units off of the system and don't replace them with anything, both reserve margins would drop below their minimums in the summer and the winter?
You'd have to take me to it. I have the volumes in front of me. I can flip through them if that's helpful. But
well, subject to check.
Subject to check. I'll accept that that's what he said.
Okay, so wouldn't that at least suggest that there could be a big gap in not just the winter but the summer within the next 10 years?
It does suggest that there could be a gap, yes.
Okay, and excuse me, let's check on my notes. And let's see, sorry, I lost my place. Now regarding Dominion's arguments as to why there should only be capacity value in the winter, are you familiar with the Commission's decision to reject those same arguments in the 2019 proceeding? Specifically, that's Order 2019-184E. Did you have a chance to review that order?
I don't have it up in front of me,
Okay.
so I don't have the specific language to mind.
I will go ahead and share my screen then. Just ask you to read two portions. Let's see. Now, can you see see this text order number 2019-847?
Ms. Clancy, can you enlarge that a bit, please?
Yes, of course. Is that better?
Marginally.
Marginally, okay. How's that?
It's about the same, but I think we can make
About
do.
the same. Let's see.
As long as,
Is that better?
yes, as long as
Okay.
the witness can read it too.
Right. Can you see that, Mr. Goulding?
I can. I do appreciate the larger size, though.
Okay. I'm glad I was able to figure it out. Would you please read this highlighted sentence?
Sure. Because DESC needs capacity in the winter, and solar does not provide capacity either on early winter mornings before sunrise when the system peaks, or during non-peak hours on most non-summer days when the system peaks before sunrise or after sunset, DESC concluded that incremental solar will not allow DESC to avoid any future capacity costs. The company therefore asserts the capacity value of additional solar QF generation is 0.
Thank you. I'll just unshare. And now, asserting that solar has 0 capacity value implies that there's 0 capacity value in the summer, correct?
I'm not convinced that I would agree with you on that specific assertion. Right?
Okay.
In other words, and this is purely hypothetical, I'm just making things up. I'm not suggesting this is true for South Carolina, right? We could say that there is a need for capacity at 8 p.m. in the summer, right? So let me modify that to maybe 10 p.m. is better. The sun may still be up on the longer days in July, but let's say that there is a need identified at 10 p.m. Just because solar can't meet it doesn't mean that capacity doesn't have value. And so
right.
I think it's important to separate those two aspects, right? Let's imagine that we had a summer peaking system. The peak was at 10 p.m. In July. There would be value to capacity or incremental capacity. It's just that solar wouldn't be able to provide it.
Okay. Well, would you at least agree that Dominion has asserted some of the same arguments that you just read in this proceeding regarding the absence of summer capacity value?
Yes.
Okay, and I'm just going to share my screen again. Probably shouldn't have unshared it. And so now I'm just going to scroll down in this order. Sorry. Everyone dizzy. And then would you read this highlighted sentence?
Sure. After considering the evidence of record on this issue, Commission concludes that DESC's position that incremental energy supplied by solar QF facilities will not allow it to avoid any future capacity is not reasonable.
Thank you. Now, if the Commission were again to reject Dominion's proposal to only value capacity in the winter, is it your understanding that Mr. Searcy has provided recommendations for a seasonal allocation that values capacity additions for other times of the year?
Yes.
Okay. And Mr. Searcy based that recommendation in part on an analysis of historic hourly load data that showed Dominion has experienced more summer peaks than winter peaks in recent years, correct?
Yes.
He also found that even accounting for existing solar, the top 1% of load hours on the system included a very large number of hours during summer afternoons, in addition to the high load hours during winter mornings. Do you recall that?
Yes.
So, given Mr. Cersei's testimony and the impending coal retirement, wouldn't you at least agree that Dominion, in all likelihood, has some summer capacity needs? At least more than zero?
I think it depends on what years we're talking about and whether they're within the 10-year time frame of this particular proceeding. So, and I don't want to go much beyond that, but again, I would note that in the electricity sector in particular, the past is becoming less and less an indicator for the future. And so the analysis put forth by DESC is based on modeling. Granted, some of that modeling, we can question some of the assumptions, but it is a forward-looking piece of analysis. And so while I believe that you can build a case for some capacity value in the summer period, I think that it's possible that this is fairly far into the future. I do think it's something that should be revisited, as I believe we recommend in the next 2-year proceeding. But I think my concern is I would want to be cautious about placing too much weight on historical analysis of peak load hours, given the way in which the sector is expected to evolve over the next 10 years.
Right. But also looking ahead, again, just going back to our earlier conversation, there is that big coal retirement within the next 10 years coming up. Isn't there? Correct. And just to be clear, whether or not we know for sure either way, isn't there at least a risk of overcompensating QFs in these winter hours and undercompensating during summer hours if we, say, got the capacity value wrong?
First of all, and I think we talk a little bit about the potential for misplaced precision, any number that we come up with is always going to be at least a little bit wrong. And so I think that what we're trying to do here is to come up with something that we think is the best fit while acknowledging that there are potentially other plausible outcomes. So I think that the question from a policy perspective is whether the true reliability challenges are going to be highest in a subset of hours in the winter, or whether there are some additional hours in the summer where under a particular set of conditions, there is an additional reliability need that would result in a capacity value, whether or not solar is able to meet that capacity value. So, I mean, first of all, I'm of the view that the avoided costs should be based on the avoided utility costs without thinking about whatever technology the QF is likely to be. And secondly, if you went through and let's say that you ran 20 scenarios, and in 10 of them, winter was clearly the area in which you had a lower reserve margin across a few hours, and that difference was clear. And then you had 5 where it's not so clear, and 5 where there was where summer reserve margins were almost as low as winter, right? I think under those circumstances, I would argue that there was a need for capacity in the summer as well as winter, because you had 5 out of 20 scenarios in which the summer reserve margins were as low as the winter ones. But it would really depend on the number of scenarios that were run, the associated probabilities. All of those would have to factor into thinking about whether a summer capacity value should be assigned. So I'm not convinced that what DESC has proposed results in significant overcompensation in the winter or significant undercompensation in the summer, based on current expected conditions over the next 10 years.
And based on the data you've seen, but again, isn't it correct that you only the data from winter months was made available for your review?
That's correct.
So you didn't have a chance to see those summer trends and compare them to the winter trends, isn't that correct?
Correct.
Okay. And did LEI have an opportunity to review the commission's order, specifically order 2020-244, the order on reconsideration from the commission's from Dominion's 2019 proceeding?
Again, I don't have the specific language to hand.
Okay. Well, did you review it, or did you not have a chance to?
So let me look at the.
I'm happy to pull it up.
Yeah. I don't want to assert that I've looked at something or not looked at something without actually looking at what we put in our report to say whether we actually relied on it. So that was my only concern.
No worries.
Please put it up if that's helpful.
Yes, that's no problem. One second. Make it a little bigger. And so here, can you see this highlighted text?
Yes.
And the commission says, additionally, Act 62 requires transparency from the utilities in the avoided cost proceedings. The commission expects and requires a much more detailed and transparent analysis concerning the seasonal and hourly value allocation for solar generation in the next avoided cost case.
Yes.
I'm going to share that. So assuming that the commission adopted LEI's recommendation on seasonal capacity allocation, wouldn't the commission essentially be asking Dominion to provide information in 2023 that Dominion should have provided in this 2021 proceeding?
So I think in our report, we've said that we believe that there's room for improvement with regards to transparency.
Right.
Now, as I've also said, we didn't direct an IR on this topic to the company. And so while we do believe that the initial filing could have been clearer with regards to some of the underlying assumptions, I certainly don't want to be asserting that the company is unwilling to provide more information. And I also think that these filings are a process, that each one gets better than the one before with additional guidance. And so I think that the commission needs to balance between working with the information that's available to everyone for this particular proceeding and encouraging the company to provide more information for the future. So I don't think that it would necessarily harm customers. fact, I wouldn't have made the recommendation if I thought it did, for the commission to accept our recommendation, along with a recommendation that in the next proceeding there be more information on this particular topic.
Okay, and I just wanted to have one follow-up question on your answer. You reviewed Mr. Searcy's rebuttal testimony, correct?
Yes.
So do you recall that he did submit a discovery request on this summer versus winter seasonal allocation, but only received the same information you received on winter months?
Yes.
Thank you. Okay, changing gears slightly. I did want to ask a few questions about standalone solar resources. As noted earlier, LEI is recommending adopting a technology-neutral capacity rate for all QFs, including standalone solar resources, correct?
Yes.
And under this recommendation, because LEI is not at this time saying that Dominion should update its capacity valuation under the technology neutral rates, QF signing contracts in the next 2 years, regardless of resource type, must generate in the winter morning to receive compensation for capacity. Is that correct?
Yes.
And so isn't it likely then that standalone solar QFs will receive little to no compensation for their capacity value under this arrangement?
So,
Oh, excuse me, sorry.
Yeah. Sorry.
Continue.
With regards to developing avoided costs, I believe that the calculations should not be based on whether or not any particular QF is going to be able to receive compensation, but on when the utility actually incurs those costs. And so from our perspective, the costs arise in those winter mornings, and whether or not the solar QF is able to attain any value in them is of great importance to the QF, but shouldn't be a factor in determining the utility's avoided costs.
Right, absolutely. I understand that. And I guess what I'm just trying to understand here is what the impacts of this recommendation to make the technology neutral rate available, but keep the seasonal allocation would be on solar QFs, understanding that the consideration of that impact doesn't go into development of avoided cost rates. Just understanding the practical implications.
Sure.
It's unlikely that solar QFs would receive compensation under this arrangement for their capacity value.
I agree.
Okay. And I raise that because Chair Williams has asked several witnesses in this proceeding why there have been no new solar QFs in Dominion's territory since the Commission's last avoided cost ruling in 2019. And again, understanding that this shouldn't be a consideration in developing avoided costs, but wouldn't you expect that one reason solar QFs may not be coming online is that it's not financially viable?
Well, I mean, the past 2 years have been obviously unique for everyone, encompassing everything from uncertainties with regards to tariffs on equipment that goes into manufacturing solar panels,
right,
to COVID, to where is the tax policy going to end up with regards to the phase out of the ITC. I mean, from by definition, if nobody showed up, it's because they didn't think it was financially viable to do so. And that's, I mean, you can talk about other barriers, maybe people weren't aware of the opportunity or things like that. But that's a reasonable assumption, but that's not necessarily an indictment of avoided costs. It may be, if you have a separate policy objective, if you say, I believe that, we need more solar to meet the needs of South Carolinians, that you achieve that through other ends. But the avoided cost calculation doesn't exist to make QFs viable.
Right, absolutely. But I guess, assuming all things, holding all else equal, under the current avoided cost rates in place now and that were approved in 2019, solar QFs would have received a year-round capacity value of 11.8%. Isn't that right?
Subject to check, yeah.
And wouldn't you agree that receiving zero or close to zero capacity compensation, as would be the case under Dominion's proposed seasonal allocation, again, assuming there are many factors, may further disincentivize solar QFs from coming online, theoretically?
Yes.
And at the Duke avoided cost hearing, in response to Commissioner Williams' question about the impact on ratepayers of shifting capacity from summer to winter, you expressed a concern that assigning all capacity value to winter may effectively signal to new resources. We only care if you show up in winter, even though there is some capacity value to new resources in summer. Do you recall that?
Yes.
And so I guess I'm wondering, are you concerned that adopting Dominion's proposal to allocate all capacity value to the mornings in the winter months might send that exact signal to potential QFs?
I think it's something that has to be considered in any proceeding. Mm-hmm. But I also have a concern that we make sure that we have a foundation under the calculations for which hours we assign capacity value to. And so there's also a question of whether, let's say hypothetically you're at 120% in terms of your capacity value. Does that mean that 121% is worthless? Or should we assign a little bit of value to that additional increment of capacity? Right now, the way that the calculations are done, it's basically saying that once we've assured that we have no need based on 120% in the summer, for example, we're not going to compensate for 121%. Now, that's a little bit different than the way that capacity mechanisms work with demand curves in PJM or ISO New England. But for this particular construct, essentially what has been decided is that once you've met your target reserve margin, there's no value to incremental capacity. So while I do continue to have concerns about assigning everything to winter, I believe those concerns are best met by augmenting the data in the proceeding 2 years from now, and by presently signaling that there is the need primarily for the winter.
Okay. But I guess generally you would agree that even resources that provide primarily summer season capacity value should be appropriately compensated for that value.
Well, I like seasonal capacity mechanisms that separate winter from summer and assess them completely separately. But that's not what we're talking about. Well, let me step back a minute. In organized markets, I believe there is some benefit to separating summer and winter capacity periods. I think in the context of this proceeding, we don't have an organized capacity market. I also would note that even if we did have a seasonal capacity mechanism of some sort, it's quite possible that the capacity value would be back in that kind of late evening period rather than in the period that the solar QS would be generating. So I like granular price signals, but right now we haven't seen the evidence that what Dominion proposed is unreasonable. We'd like to see some additional evidence in future proceedings, but we don't believe that what Dominion has proposed is unreasonable for the purposes of this proceeding.
Okay. Thank you. That was a lot to get through. I did just want to turn to one other issue relating to Dominion's avoided capacity rates. Like Mr. Searcy, you found that Dominion's presentation of its SAS or SAS results in support of its ELCC calculation was unusual, correct?
Yes.
And can you just elaborate on that point? Are you saying it was unusual for Dominion to present the loss of load results without showing the supporting calculations?
Well, and I don't want to exaggerate this point too much, right? I think that what we said in our report is that we've observed in other proceedings additional material that goes into more detail about how the loss of load expectations were developed and which shows the number of scenarios that were looked at and gives further background to the calculations. SAS is a pretty unique program. It's not something that a lot of interveners are likely to have access to. It makes it more difficult to replicate the calculations. But we're not suggesting that DESE is misrepresenting that that's what they did, right? Or that that's how they used it. So all we're highlighting is that it's unusual. It's not a program that even a well-funded private firm necessarily would be using. Okay. And so we felt that on that particular topic, a more lengthy discussion of those calculations would be worthwhile.
Okay, so it sounds like you would agree with Mr. Searcy that should Dominion propose an ELCC calculation in future proceedings, it should include the supporting calculations in a more complete format, that might help interveners at the very least understand.
Yes.
Thank you. Now, turning to avoided energy rates, you and Mr. Searcy were aligned on several recommendations in this category as well. First, LEI agreed that, as with capacity, the use of a single technology-neutral energy rate was more appropriate than the use of a solar-specific rate, correct?
Yes.
And in support of that recommendation, you explained that avoided cost pricing calculations should be based on utility costs rather than the nature of the technology receiving the rate, correct?
Yes.
Right. And in its own modeling, LEI adopted the same approach as Mr. Searcy to forecast the long-term gas prices, correct?
Yes.
And that approach uses the EIA reference case, which is developed to reflect long-term pricing trends. Is that correct?
It uses it in later years, in the near term, the forwards are used.
Right. And then, okay, it's a long term. And then, but LEI ultimately concluded that Dominion's long-term gas price estimate was also reasonable, correct?
That's correct. We noted that it is within the range between the low and the high gas price outlooks that are created in the annual energy outlook, and that it was developed using a process that is similar to an approach that we have used in the past. And
Okay.
so we don't ultimately, there are a variety of ways of developing assumptions. Nobody has any perfect way of saying what gas prices are going to be 10 years from now. Ultimately, if the projected gas prices are within an accepted range, I think that it's appropriate to say that they are reasonable.
Okay. And since you brought up that range, I did just want to look at the LEI report on page 42, and I'll pull it up on my screen with you. Give me one moment. And can you see that clearly?
Yes.
Okay. And Madam Chair, can the commission see that as well?
Yes, thank you.
Great. Okay, so you've found, as you just noted, that Dominion's gas price outlook was within a reasonable range because it fell between the high and the low. And I'm not sure if you can see my cursor, but the low EIA reference case is this pale green at the bottom, and the high is this dark green. Is that correct?
Correct.
Okay, so that's quite a wide range of prices, is it not?
Yes.
Okay, and Dominion's gas price forecast is this red dotted line, correct?
Yes.
And so isn't it correct that this line most closely tracks the low EIA reference case?
Yes.
Okay, and then, but LEI and Mr. Searcy's long-term gas prices track the EIA reference case.
Yes.
Okay, and in fact, this yellow dotted line is Mr. Searcy's gas price outlook, correct?
Yes.
And that most closely tracks the EIA reference case.
Yes.
Thank you. And so, I think you touched on this, but Dominion's approach to forecasting gas prices involves applying an EIA escalation rate to current NYMEX prices, correct?
Yes.
Okay. And so one of Mr. Searcy's primary concerns was that this approach effectively carries short-term price effects through the entirety of the forecast, producing an unreliable forecast. Do you recall that critique?
Yes.
Okay. And so, for example, in recent months, NYMEX gas futures prices have risen substantially, 55% for year 2022 and 31% for year 2023. Have you been tracking this increase?
Yes.
And so isn't it true under Dominion's approach to forecasting long-term gas prices that fluctuations in the course of months could end up getting carried forward all the way through year 10 of the forecast?
Well, that's all. Any approach that you take is going to be driven by the circumstances at the time that you do the forecast. And, even in terms of the way in which the AEO lays out their particular forecasting bands, that's based on the information that they have available to them at that time. So, in the past, when we've deployed the approach that Dominion used, it was because we saw, at the end of the period for which we felt that forwards were reliably available, and because forwards get less and less liquid the further out you go, it's only appropriate to use some of the initial periods, somewhere between 1 and 3 years. Practitioners differ on which. In our up until 2020, what we found was we felt that the AEO forecast had an upside bias, right? And so, if we had taken Mr. Searcy's approach at that time, we felt that would result in prices that were unrealistically high in the back end. Whereas now, what we find is that the AEO has come down in the back end, and we think that that's more reasonable, and that's why we don't currently deploy the approach that Dominion does. And I can't say one way or the other what approach Dominion would take right now, looking at the data. So what I can say is that at the time that they deployed it, it was, it resulted in numbers that were within a plausible range.
Okay, but I guess, but the EIA reference case does take into account long-term trends, even if it is, say, taking into account those trends, even though that's going to be obviously affected by what's going on at the time, does it not?
Yes.
So, whereas the approach that Dominion has used is applying an escalation rate to whatever the prices happen to be at the time that they apply it.
Well, they're not making that escalation rate up.
Right, it's the NYMEX price.
Well, it's actually, I believe,
the escalation
AEO, the escalation that's in the AEO, and so.
Oh, right. Excuse me, you're right.
And we've been in a period of extremely low natural gas prices. People are, concerned because they see them doubling, but even with natural gas prices doubling, if we were to go back 10 years, we would find that, gas prices were higher. And so I think that the challenge for analysts right now, I'm saying as of October of 2021, and it's going to be a challenge for the folks that put together AEO as well, is whether natural gas market dynamics have changed so much that for a variety of reasons their low or high end forecasts are no longer viable, or maybe the slope is different. That's something that they're going to have to look at in the next iteration, which I believe would probably come out late spring of 2022. But my point is that reliance on near-term price trends may not be completely divorced from changes in fundamentals that will play out over a 10-year period.
Okay. Just as an aside, this kind of these changes in gas prices that you're referring to, and this sort of recent increase in gas prices, doesn't that highlight one of the advantages of contracting for renewables like solar that provide a fuel hedge?
Yes, I believe that I've made that point in testimony elsewhere.
Yeah. Okay, well, thank you. And just one last question on this subject matter. You did say that LEI had an opportunity to review Dominion's IRP. I'm wondering if you had an opportunity to look at the commission's order in that proceeding.
We were focused on the IRP itself, not so much the order.
Okay, so in that proceeding, the commission agreed with Mr. Searcy that it was more appropriate to rely on industry standard market models than on escalation rates from current data points. And so it sounds like you think that is one reasonable conclusion.
Well, I think that there's two things to be aware of, right? Which is that ultimately you want all 10 years of your forecast to be internally consistent. And so, as I said, I can't say what conclusion Dominion would come to at the present time. One of the things that we've focused on as we do our own modeling, which we more or less update models for every region every 6 months, is there a step change between the forwards? And forwards provide important information because I can trade on them tomorrow. And so, for the first 1 to 3 years, we would be very, very hesitant to throw out information from the forwards market, right? As we get out into that 3-4 year period, then we say, look, there's very few trades for 5-year or 10-year gas. So we've got to look to another source or do our own independent modeling of natural gas markets. And we're mindful of whether there's a step change, right? If we say, you know what, we're going to do 3 years of forwards, and then we're going to pick year 4 to 10 out of the AEO reference case. Well, what does that look like? And does that give us something that's plausible between year 3 and year 4, right? And where we've come out is that if there's a big jump, there's a step change, then we're more comfortable using the escalation rate from AEO than we are using the actual numbers. If there's not a step change, right, then we would apply the AEO because we don't think that in terms of the long-term forecasting, that having that kind of step change in year 3 or 4 makes sense. So I think that assessing the forecasts takes judgment, and there are times when either approach might be appropriate. The other thing to bear in mind is that there's not a one-to-one correlation. Let's say that one gas price track is on average 10% higher than another gas price track, right? When you run that through the model, there's going to be at least some changes in dispatch that will tend to moderate the impact on the resulting electricity prices. So we need to be aware that there is a degree of judgment that goes into developing those gas price forecasts. If we had seen Dominion's pricing being below the range, we would have said that it needed to be updated. Using the time at which it was performed, we would say, yes, we're assuming something that's higher, but we believe that reasonable analysts could come up with a lower price trajectory and that Dominion's was within that range.
Okay, thank you. There are just 2 points the answer you just gave I want to follow up on to make sure I understand. When you talk about avoiding that step change, another way to avoid that is the approach that Mr. Searcy took of blending the NYMEX and the EIA reference case in I think it's year 2 and 3. Is that correct?
Yes, that's correct.
And then, and you mentioned it being important that the 10 years of forecast be internally consistent. So I guess even assuming that Mr. Searcy's and Dominion's approach to gas prices are reasonable, wouldn't it make more sense for Dominion to use the commission-approved methodology that is already being used in its 2020 IRP?
Well, the documents were produced at different times, so I can understand potentially using a different approach. I think as we've stated, different analysts can defend using different price tracks. And while I can understand the view that what you use in the IRP is something that you would use for the avoided costs, I think there's also there are decisions that are made at the time that the forecast is made that are specific to the conditions then, which may not have prevailed at the time of the IRP.
Okay.
So.
I guess, though, from your review, are you aware of any discernible reason why Dominion would not use the same commission-approved methodology currently being used in its IRP?
So I think that you could defend using either, and that Dominion could have chosen to continue using what they used in the IRP, and that would have been defensible. Whether that's better depends on the objectives that you're trying to conceive. If what's most important is, consistency of method between two different processes, then, of course you'd argue for using the same one as the IRP. If you're concerned about having a method that produces some short-term results that are closer to where forwards are, while still taking into account general long-term trends, then you might decide that the approach that Dominion took is better. But you have to start by first saying, well, what does better mean? Like, why are you saying one thing is better than another? And it may not always be the case that consistency of method is the most important thing.
But to be clear, LAI didn't see a reason to depart from Mr. Searcy's methodology and its own modeling. Is that correct?
So what I would say is our methodology is developed independent of Mr. Searcy or Dominion. It is the methodology that we are using across all markets in North America at the present time, because we believe it's consistent with what we see as long-term trends at the point at which the forecast is being done.
Great, thank you. So should the commission depart from its prior finding in the IRP and approve Dominion's approach to forecasting long-term gas prices, wouldn't you agree that, especially given the recent rise in NYMEX futures prices over the course of this proceeding, that the commission should require the avoided energy rates to incorporate the latest NYMEX prices?
It's a very difficult question, and it's one that we've been wrestling with a lot of clients right now, in terms of whether even recently performed forecasts should be updated. I think given the magnitude of the change, I think that I would have to say that it probably should be recalculated, but again, with the caveat that you don't expect a one-to-one change in the outcomes. And that, as we noted, in terms of the way in which we did our modeling and looked at the avoided energy costs, given that there is a range of error, let's call it plus minus 10%. First of all, when you apply the higher gas prices, you're going to see some changes that will absolutely not result in electricity prices rising by the same magnitude. And the results over the near term may well not differ substantially above the margin for error. So I think that the recent run-up poses challenges for all forecasters. On balance, I would probably say it's worthwhile to redo it, but the outcomes, as I've said, will not be as dramatic as the change in initial prices.
Right. But given the magnitude, it makes sense to ensure that the commission is approving the most accurate prices to update the current.
Yeah, as I'll reiterate with everybody, the word accurate, I have some concerns with, because, we're all going to do our best, but, there is a zone of reasonableness, and I would say accurate within that zone of reasonableness.
Excellent, thank you. Changing gears, LEI also found the pricing periods proposed under Dominion's standard offer rate sufficient for the purposes of this proceeding. Could you please summarize your understanding of the approach used by Dominion to develop its pricing periods?
Yes, I'm just looking, because I believe you've asked this as an IR as well.
Yes.
Yeah, so just so that I don't, just so that I'm consistent with what we're writing in this IR, that response that you have not seen, let me just read from it. The question was, please explain LEI's understanding of the approach deployed by DESC to develop its pricing methods, including the methodology DESC used to group hours into pricing periods. And our response is, as described in DESC witness Neely's direct testimony, DESC determined the 11 pricing periods for the standard offer non-solar rates by accumulating, quote, the annual avoided costs, ellipsis, into ellipsis periods by using a profile created using the 10-year average hourly marginal costs. Avoided energy costs are calculated for calendar years 2022 through 2031. These 10 years are divided into two groups of 5 years each, 2022 to 2026, and 2027 to 2031 for each of the 11 time of production periods. And then we footnoted where that is in the direct testimony. We then go on to say, DESC witness Bell further describes the company's approach in his direct testimony, explaining DESC has included time periods for these non-solar avoided cost rates based on an analysis of hourly marginal costs. Logical grouping of hours of the day and season by marginal cost value produced 11 time periods for PR standard offer non-solar, which was simplified to 4 time periods for PR1 non-solar. The 11, then we go on to say, there's a footnote that shows where the direct testimony that was. We go on to say the 11 pricing periods for the standard offer non-solar rates include 4 periods in the winter season, December through February, 4 periods in the shoulder season, March, April, October, and November, and 3 periods in the summer season, May through September. As described by Mr. Bell, the study of the hourly marginal cost profile shows sufficient difference in value to warrant 3 or 4 time periods per day, depending on the season and customer usage.
Okay, so it sounds like, based on the testimony you just summarized for me, your understanding as well is merely that Dominion, developed or defined the pricing periods with using a logical grouping. Is that correct?
Yes.
Okay. So it appears from your report that you ultimately found the results reasonable enough, but wouldn't you agree that Dominion's, I guess, methodology or methodological approach to pricing periods sounds a bit subjective
Well,
as far as drawing the lines around the hours?
the thing is, even if something appears to be quantitative, the subjectivity just moves into the formula, right? And so you can say, and I believe this gets back to our figures here. You can say, well, this seems pretty ad hoc, but if you think about it, right? Dominion has done a model, a forecasting model that goes out 10 years, comes up with marginal prices, right? We can assume that there's a relationship between reserve margins and marginal prices, that during the higher price periods, you're using higher cost resources. And that in turn is because the reserve margin is narrowing. And so when you then shape a profile to those curves, it's not that your starting point is arbitrary, right? You're actually using something that models the future. It provides for an indication of when peaks are. And we can start, you could say, okay, well, look, the price periods are, I apologize for hand gestures here, but you basically have horizontal and vertical lines, right? So you've got right angles. Whereas your actual prices hour by hour have curves, right? Because we're doing a limited number of pricing periods. We're not doing 8760. So there's always going to be periods where your price periods, where the tariff that you're proposing as an avoided cost are going to be a bit over or a bit under. All right. Now, we could develop a set of mathematical formulas that said, we only want the difference to be between X and Y, right? And, we could spend a lot of time developing those formulas, but ultimately we're doing with math what is conceptually being done in the way in which DESC described what they were doing. Did they do it perfectly? Is it necessarily the method that we would use? No. But when we looked at this, we said, did they have a method? Yes. When we actually benchmark that against the output of their models, does it look anomalous? We think it's fairly consistent with what they have. And so, our approach throughout the paper was to try and highlight things where we felt that there were large and material differences that would change if you applied a different or better approach. We did not feel that this was an area in which it was necessary for us to recommend significant changes.
Okay. But, sorry, just to make sure I understand all of that. So you say the subjectivity would just move to the formula, but wouldn't say just like comparing the ranges of prices between each pricing period provide sort of like a numerical, easy to understand benchmark for, in support of these pricing periods? If Dominion took maybe a more numerically based approach? Wouldn't that be less subjective?
Well, the subjectivity then comes into what do you think is an appropriate differentiation among the various price periods, right? Because the price periods, what you're looking at is some kind of a weighted average, I would say, of the period of their modeled prices against their fixed price for that hourly period. And then you come to a determination where you say, well, I think this much deviation is too much. This one is too little. And so, where do we come to? That's still I think that subjectives shouldn't necessarily be used as pejorative in the sense that subjective nonetheless reflects the informed professional opinion of the person that's doing the analysis. But it's not always the case that the mathematical approach will be less subjective. It's just that you're making different choices. You're saying, well, I believe that the deviation should be X, and somebody else may say, no, we want a tighter correlation. That means that we need to break these blocks into two. Right? I mean, for me, I would say, hey, we should have 8760. We should have a price sheet for every individual hour, and then we're going to match them exactly. That's clearly not practical. Right? It's possible, but I think administratively it would be a bit of a pain. And so I would argue that any approach to grouping those 8760 prices is going to have a degree of subjectivity somewhere in the process.
Okay.
So
that makes sense. And I don't want to take too much time on this, but it does, that certainly makes sense that there's degrees of subjectivity. But I guess the scenario that you're describing to me, where somebody's saying, here are these pricing periods, they have this standard deviation, this is the price range in each period. To me, from an intervener's perspective, that would provide some basis to say, oh, I see what they did. At least more of an explanation than there was a logical grouping. Wouldn't you at least agree with that? Understanding that there are degrees of subjectivity that may work themselves into different methodological approaches.
So I would agree with that, but again, I think what I want to emphasize is that our approach to our entire report was to call out the things that we thought were most important, were most different. It wasn't to go through and grade an exam and say, you could have done each 90 out of 100 things you could have done better, when in fact we think our report is more meaningful to focus on the 5 things. I'm just making up the 5 or the 7 or whatever, but to focus on the X things that we think are really important, and to say, look, on this one, sure, you could have described a quantitative method that was that provided a foundation for what you did. I mean, there's a fair amount of research that suggests that some of the things that we do instinctively are based on an understanding that's built up through a professional career, and so you could very well end up with something instinctive that matched pretty well with what the mathematical formula would be. But the focus of our report is really to say, look, if something is reasonably close, even if we think that the method could be improved upon, we're not going to say, go back and do it over just for the sake of showing how smart we are. Instead, we're going to try and focus on the outcomes, focus on what provides a reasonable balance between Dominion's ability to operate their business, entrants to face barriers to entry that are consistent with PURPA, and that customers are protected. So triangulating among those 3 is our objective in the report, not necessarily to say we could have done everything better. I mean, we're always going to say that, but what's the point, right? I mean,
Right. Thank you. And you and that makes sense. And I would just note on page 70, the report does highlight an overarching concern that that transparency, I guess, into the application in such a way that may minimize the need for interrogatories in the first place, that there is room for improvement on that front. Isn't that correct?
Yes, and I think, that we said room for improvement. We didn't suggest that Dominion was necessarily acting in bad faith. We think that, where possible in the application, expanding on assumptions and processes would be helpful. We didn't suggest that the standard was that there would be no questions asked, but rather that potentially fewer and different questions would be asked, that the process could be improved. So, we acknowledge that DSC responded promptly and fulsomely when we asked questions. We think that configuring the report a little bit differently without harming confidentiality is possible and desirable.
Great, thank you. Now, to conclude, I just have a few questions about your view on PURPA and the role it serves in the energy market. Mr. Cassis, Dominion witness Mr. Cassis submitted testimony in response to the LEI report. And in that testimony, he commends LEI's concern for inflated avoided cost rates, which result in overpayments to QFs. But the risk of setting avoided cost rates too high and passing additional cost to customers, while that is, of course, a major concern in this proceeding, it's also just one of the risks that LEI highlights in its report to the Commission. Isn't that correct?
Yes.
And so LEI also notes on page 72 that there are risks associated with undercontracting given the uncertain economy, gas prices that may no longer be declining, and the cost of technologies like solar PV flattening out. Could you elaborate on that risk a little?
Certainly. I think that it's important when we think about risks to think about them with a degree of symmetry. And so we've seen discussion of legitimate concerns about not wanting the avoided costs to be set at a level that is too high. Now, a lot of the discussion about historical issues with QF is with the benefit of hindsight, right? At the time that those contracts were entered into, there were forecasts that were made with regards to future costs that went into the calculations. Those forecasts, proved to be wrong, and they proved to be wrong in ways that, sitting in 1980, no one would have ever anticipated, right? The idea that natural gas would be plentiful, that the U.S. would be a net energy exporter, was not something that at the beginning of PURPA folks envisioned. So absolutely, there were circumstances where in hindsight, contracts were much too high. But it's also quite possible that in the current environment in which there are concerns about inflation, about global supply chains, about how environmental regulations are going to evolve, that the cost of QFs today may prove to be a bargain when we look back 10 years from now, right? And while forecasting is certainly difficult, and any individual forecast is almost always wrong. There have certainly been improvements since the early days of PURPA, right? We're not really going around offering 40-year contracts based on oil prices that based on a formula with an oil price that escalates at 5% per year, right? Just to give an example of some of the contracts that were available in the early 1980s. South Carolina's process of regularly updating avoided costs every 2 years helps to assure that whatever error there is, either high or low, is confined to the contracts that are signed in those 2 years. So I think it is important to try and balance the need you want to protect customers on the one hand from paying too much, but you also want to protect them from, let's say in year 7 or 8, having not gotten a deal that would have helped them to manage costs in the presence of upward cost drivers. And so I think it's important to recognize that even if it's true that in the past, the highs and the lows may not have averaged out, that we may be in a position where the overall environment is shifting, and deals signed today will prove to be below avoided costs 7 to 8 years from now.
Okay, so just to make sure I understand, so if, for example, if over the next 10 years gas prices continue to increase, Dominion could pass those increases on to ratepayers, but the gas prices as incorporated in today's avoided cost rates, QF will be locked into those prices.
That's correct. So the QF doesn't get to come back and say, you know what, you got the avoided cost wrong, so you owe me more money. Now, obviously, the flip side of that's also true, right? Gas prices decline to $1 per MMBTU. The customer doesn't get to go back to the QF and say, hey, sorry, we got it wrong, we're going to change the price. But that is a symmetrical proposition. I think it's incorrect to only focus on the possibility that the prices are set too high.
Right. Thanks. You also raised another risk I thought was interesting was the risk of not having a robust independent industry against which you can benchmark the costs and performance of utility services. Could you just briefly elaborate on that risk?
Yes. One of the outcomes of PURPA was the development of a diverse independent power sector. And that has made it possible for going far beyond avoided cost proceedings and PURPA proceedings. The development of that independent power sector has created the opportunity for a host of other arrangements, whether it is arrangements in which utilities issue requests for proposals and there's actually people that can show up and compete in them, whether it is partnerships where independent power producers will build a power station, maybe run it for 3-4 years and then sell it to the utilities. But the presence of an expanded ecosystem allows for the ability to hedge, if you will, against utility-only builds, which, with the absolute best of intentions, right? Nobody is saying that somebody is sitting in utility headquarters thinking of ways to exclude all IPPs and charge customers more money, right? I mean, but utilities have a particular way of looking at the world, and it's important to have some alternatives so that we can understand the trade-offs between the value that an independent power producer provides and the value that the utility process provides.
Great, thank you. So I guess it sounds like you would agree that then that PURPA still continues to provide some value to the energy market and ratepayers as a result.
Yes, I think that the challenge, when we think about a vertically integrated near monopoly, is what are your alternatives if you don't have a competitive wholesale market? How do other players enter, and how are you able, because with the best intentions, no regulatory commission is going to have complete information. So one of the benefits of having IPPs is you have a cost benchmark. Now, utilities may raise some legitimate concerns about whether that's an apples-to-apples benchmark or whether there are hidden costs. We've seen in the discussion of the VIC, how do we talk about integrating these? But ultimately, from the perspective of a regulator, having multiple entities that are able to provide additional information is a benefit, and ultimately customers benefit from that as well.
Great. Thank you so much. That was a lot to get through, but I really appreciate your time. Thank you, Mr. Golding. That's all I have.
Thank you so much.
Thank you.
Thank you, Ms. Clancy. We've still got a couple of parties to get through on cross, but we've been going a little over an hour and a half, so let's take a 15-minute break and return. Well, actually, about an 18-minute break. We will return at 3:45. Thank you. Good afternoon, and we will resume this proceeding in docket number 2021-88E. Let's take a roll call of commissioners. In the hearing room, we have Commissioners Thomas, Commissioner Carolee Williams, Commissioner Powers, Commissioner Belser, and joining us virtually, we have Commissioner Caston and Commissioner Irvin. And Mr. Goulden, you're still on the stand. And Office of Regulatory Staff, do you have any cross-exam for the witness?
Thank you, Madam Vice Chair. We do have a few questions for Mr. Goulding.
Please proceed.
Good afternoon, Mr. Goulding. My name is Chris Huber. I'm counsel for ORS in this matter. Like I said, I believe we just have a few questions. I believe most of these questions will be primarily clarifying in nature. Wanted to ask initially a couple questions about your recommendations regarding energy rates. Would you agree that assuring customers do not overpay for power generated by qualifying facilities is the key objective in determining avoiding costs in this proceeding?
Yes.
And is it your recommendation that solar generators on rate PR1 be compensated using the same four time of use energy rates proposed by DESC and modified by ORS for non-solar PR1 generators?
Yes.
And are you familiar with the testimony of ORS witness Brian Horry, where he testified that using average energy rates for 4 time of use periods can overpay solar generators?
Yes.
Did you perform any analysis to determine that using the 4 time of use energy rates would not overpay solar when compared to the payments the generators would receive using hourly energy rates?
So I'm not convinced that depending on how the solar facility is configured, that the overpayment would result in the same calculations as witness Ori. However, I did not do additional calculations because my objection is based on the view that you cannot have 2 different avoided costs for the same hour. I believe that the avoided costs need to be based on the utility's actual estimated avoided costs, and that those avoided costs are going to be what they are in any individual hour.
Am I correct in the report? One of the reasons that technology neutrality is recommended is that you stated provides clear price signals. Is that correct?
That's correct. I mean, my preference, as I stated previously here, in an ideal world, we would have very, very granular price signals. And so we wouldn't have the problem that the area in the shape of the curve that's developed using the pricing periods doesn't match the area in the projected price the projected price curves that have been modeled, right? But that there are potential administrative challenges in having not just 8760, but over a 10-year period, you'd actually have 87,000, more than 87,000 different individual price points that you would be putting out there for the QFs to respond to. That's it's not insurmountable, right? You could actually do it, but it's very unusual. Nobody has actually done that in a traditionally regulated, vertically integrated market. So, with that in mind, the price periods are compressed, but they should be reflecting the company's avoided costs in whatever period they're being assessed. I believe that price signal is given by the avoided costs. It's not, the challenge is that the development avoided costs isn't really about giving necessarily a price signal at all. It's about figuring out what is the cost that the utility avoids. And so if I were designing a wholesale market in terms of the price signal that I would provide, then I'm going into 8760. In fact, I'm going into 5-minute increments within that 8760. That's not what we're doing here. We're trying to calculate the avoided costs over particular periods and to say that this is how we're compensating the various entities. And so within that constraint, then I still want the price signal to be as consistent as possible, but ultimately it's the avoided costs that are driving it, not the design of a perfect price signal.
Thank you, Mr. Goulding. I just have really one final question. If the London Economics Report were accepted in its entirety in this proceeding, would it be harmful to customers?
No.
Thank you. Madam Vice Chair, that's all I have for ORAS. Thank you.
Thank you, Mr. Huber. Dominion Energy, I'm not sure who's going to be questioning, but.
Good afternoon, Madam Chair. Mr. Goulding, how are you doing this afternoon?
Good. How about yourself?
I'm doing great. My name is Mitchell Willoughby, and I have a few questions for you. On that very last question that Mr. Huber asked you, the effect is if the report on LEI were adopted in full, the impact on rates that would be, or costs that would be passed on to customers would be roughly 40% higher than what Dominion has proposed in this proceeding. Is that correct?
The impact would be mostly confined to the capacity charges. And then to determine the cost for consumers, we'd also have to look at who is exactly showing up in those particular hours to determine how much was being put forth. I think you're asking me to compare, given that, would the cost be higher? And yes, it would be higher than what Dominion has proposed. I don't think it would be exactly 40%. I'd have to look at the numbers. Higher doesn't necessarily mean worse. We're not trying to target higher or lower than what Dominion has proposed. We're just trying to get to something that we think is a reasonable avoided cost calculation.
True, and I'll come back to that in a little bit, and I may actually ask you over the evening, assuming you remain on the stand over the evening, to take a look at that and do that evaluation. My calculations are roughly 40%, but based on all of the recommendations you've made, but I would want you to confirm it. But we'll come back to that. I want to talk with you just in some general terms. Are you generally familiar with the amount of solar that is developed throughout the southeastern United States?
Yes, generally.
Correct. And you would then know that that Dominion Energy South Carolina, even though relatively a small utility, is the second largest utility system in the Southeast with solar on its system, right?
Yes, subject to check. I mean, I always want to make sure that I'm understanding the units that are being used and the, you know, whether we're talking about it as a percentage of the system or whether we're talking about absolutes. But yes, I understand that it is one of the leading service territories with regards to solar penetration.
And the information we have would indicate that the only company, and it's a larger company in the Southeast, other than Dominion Energy South Carolina, is Duke Energy Progress, which has a much larger territory throughout the Southeast than does Dominion Energy South Carolina. Would you agree with that?
Yes.
And Dominion Energy South Carolina currently either has 1,000 megawatts online or coming online in the foreseeable future. Do you agree with that?
Yes.
And for a utility of Dominion Energy South Carolina size, that is a substantial percentage of generation capacity. Would you agree with that?
Yes.
And in fact, the Southeast average is roughly 423 megawatts as of 2020. Do you agree with that average being roughly correct?
That I'd have to look at the calculations to understand what was going into the average. You know, I'm confident that you have some numbers that come up to that average. I just don't know, you know, how many companies are going into that and how it's being calculated. So
So if you have any resources that you rely upon, you certainly feel free to look at those sources. But information that we have would indicate that in 2020, the Southeast average was roughly 423 megawatts for large-scale utility systems. And if that number is correct, then Dominion Energy South Carolina would have more than twice what the Southeastern average is in terms of installed solar. Is that correct?
yes.
And you were asked a couple of questions by Mr. Burns, I believe, on Santee Cooper and why Santee Cooper may not have a VIC. Do you remember him asking you about Santee Cooper?
I do.
And would it make a difference to know that Santee Cooper has very little solar, less than 100 megawatts, and very little of that may even be online and operating at the current time? Are you aware of that?
It doesn't surprise me, nor does it surprise me in those circumstances that a VIC or something similar, an integration charge, would not have been developed.
And that's a very point I would ask you, Mr. Grady, is that with that minimal amount of solar on its system, then it's not a surprise that it would not have developed a VIC for integration at this point. Is that correct?
That's correct.
Now, I just want to, while I'm on this subject, I want to talk a little bit about just the variable integration charge. Would it be true in your experience that if two balancing areas have essentially the same amount of solar, but one balancing area is significantly smaller than the other, that it would stand to reason that the smaller balancing area would have a higher cost to integrate solar onto its system?
Well, there's a number of factors that would go into that. I agree with you that size is a factor. You'd want to look at a number of other things, the age of the resources in the respective jurisdictions, how flexible they are, what the plans would be for changing them, the level of interconnection. But the smaller your system, each system has some unique characteristics. What you're looking for is that the system have a variety of resources that have a fairly high degree of flexibility. So you could theoretically have a smaller system that had lots of flexible resources, lots of demand response, some brand new quick start resources that would have a lower cost of integration than the larger system. But if we said, look, proportionally, it's the same. We've got kind of the same amount of demand response proportionally across the systems, then it's possible, provided the systems aren't well interconnected, that the smaller system, you would expect it to have a higher integration charge.
And so at least from your experience, as you've just explained, all other things being equal, a system that might have a balancing area that would be only 15 to 20% of what a much larger system might have, you would anticipate that the smaller system would have a higher integration cost to integrate solar onto its electric system, correct?
Yeah, I think that's reasonable, given the other caveats that I stated.
Perfect. Thank you very much. I want to talk with you a little bit about the issue of transparency. And let's see if I can share my screen here. I'm going to try to pull up your LEI's interrogatory responses to let's see if I'm successful in doing it. So that's not the right one. Let's see if I can. Actual report. Here we are. Now, all of those other things that I just clicked away, I'll probably have a challenge pulling it back up, but we'll see it. This is the only one I need right.
Mr. Willoughby, can you enlarge that a little bit?
Let's see if I can, Madam Chair. Does that help it a little bit?
It does, but you're going to need to readjust it within that frame. There you go. Thank you.
How about that?
Thank you.
So, Mr. Gooey, when you and your team responded to these interrogatories, you were attempting to do so in good faith and fully transparent, correct?
Yes.
And in fact, when you did your report, the consultant's report, that's been entered into the record, you prepared your report in a fashion that you thought would be fully explanatory of the points that you were trying to make and the information upon which you were relying in order to reach the conclusions you reached, correct?
That's correct.
But notwithstanding you doing your very best, and you did a good job, you think, correct?
I've never submitted a report that I felt was a crappy piece of work.
That's right. It was always top of the class in terms of the discipline that you used, in terms of doing the analysis and the care in which you took.
All right. I didn't want to interrupt. I wasn't sure whether you were finished with your question there.
No, go ahead.
But it's certainly been my objective throughout my career to provide reports that are complete, useful, that are clear about our conclusions and clear about how we got to them.
And notwithstanding that, then nevertheless, there were questions that were propounded to LEI, correct?
That's correct. And I do want to make clear that our standard was not that there are no questions, but rather that that a report be as clear as is reasonable for the nature of the product to have the basic assumptions in there. So my standard was not that you get to zero, but potentially that you get a different kind of IRs.
So what would be the standard? The 5, 10 questions that you might get?
Well, I think that in our report, we actually referred to a list of items that another witness had put forth with regards to a basic checklist. And so what we're saying is that you try and anticipate broadly the questions that folks might have. And, in a normal report on topics like this, it is important to have the discussions about natural gas prices, about your load forecasts, the extent to which you're linked to the IRP, sometimes a discussion of scenarios, all of those kinds of things. And so, you're right that my standard was not zero, and we recognize that there's always going to be things that are questioned. But our observation was that there was additional fairly straightforward information that we would recommend in the future that DESC include in its report.
And they all very true. And you indicated that there was someone that had made a proposal with some ideas that you accepted. Who was that had made those proposals, Mr. Goody? If you recall.
If you give me a minute, I can pull up the actual footnote.
Is it from your report?
It's from the report, yes.
Let's see if I'm good enough to.
I believe it was Mr. Searcy, actually.
Okay, that's what I recalled, and I think you just had some questions, I think, from Ms. Clancy, who represents the entity for whom Mr. Searcy was testifying, correct?
Yes, that's correct.
And I think earlier today, Mr. Burns, on behalf of CCEBA, asked questions of you, correct?
Yes, that's correct.
Would you say that those very good lawyers were advocating through their questions on behalf of their respective clients and the respective positions advanced by their clients?
One would assume so, yes.
And would you, you sat there and listened to the questions and responded to them, and I sat here and listened to them as well. I would say that was an effort to advocate on behalf of their client for the positions that they were advancing, correct?
Yes.
And would you expect that Mr. Searcy was doing likewise with the work that he was advancing?
I think we have to look at what any professional does in terms of being a witness as having two parts. I think there's the part that is common to all experts, in which they're trying to demonstrate their competence, their capabilities, and to assert a common understanding of the world. There is a part that may, depending on the nature of their relationship, incorporate some advocacy. And that ideally should be clearly delineated. So I don't think that in terms of the list of things that Mr. Searcy enumerated, that that's necessarily something that is unique to his client. So, and I think, or I hope you'll find that I don't just agree with anything that's put forward to me without thinking about it independently. I would not have accepted those particular recommendations if I thought that they were based on just pure one-sided advocacy. So I think that, yes, I understand your perspective that lawyers advocate on the part of their clients and that experts work for their clients. But that doesn't mean that everything that they say is biased or unbalanced.
And I agree with everything that you just said, Mr. Gooding, and obviously you have to evaluate the issue that may be being discussed. Have you ever testified, Mr. Gooding, in civil litigation as an expert on behalf of a particular client?
Civil litigation. Let me think about that a little bit. I have been involved in tax disputes in federal court. I'm not sure that you would call that civil. I mean, if you're talking about between two private parties, I have been involved in payment disputes, I think is the best way to characterize them, between two entities. I haven't done a lot of civil work. Most of the work that I have done has been regulatory or has been really related to even the tax cases. Obviously, it was not as a tax expert, but to talk about the electric power industry.
So it's primarily been, at least your civil work, described, as you described, it would be a tax issue where you're basically trying to present a position to, I guess, a taxing authority like the Internal Revenue Service or state taxing revenue department, or on the other hand, where there might be a payment dispute between two private parties. Is that basically the universe of what you testified to in civil matters, as you recall sitting here today?
Yes, to the best of my recollection, and as I understand the definition of what a civil matter would be.
Correct. And so now let's return to this SECBA interrogatories to LEI. There's you answer 1 and 2 and basically indicate that you concluded that, and we're going to talk about this in a minute, that an independent study should be performed, and then you talk about continuing the BIC at the current level, subject to additional consideration. And then there are a number of other questions. Please see response to 2 above, that's 3. 4, please see response to 2 above. 5, please see response to 2 above. 6, please see above. 7, please see above. 8, please see above. 9, please see above. And Mr. Burns asked you about a few of these. And do you recognize that if Dominion Energy of South Carolina had filed some of these responses, we would have been accused of avoiding answering the question. We would have been accused of not being transparent. We would have been accused of not fully responding. You recognize that your position here is a favored position, and you're treated in a favored way, whereas Dominion Energy may not have that same sort of treatment. You understand that, don't you?
Well, I guess there's a couple of ways that I would respond there. I mean, first, we believe strongly that we produced a piece of work that was transparent, consistent with our scope. And we believe that the questions that were asked were, we believe that we performed the work that was necessary to develop the conclusions in our report. And I would, I think, draw a distinction between the way a report is crafted and responses to interrogatories. As I've said earlier today, we have concerns about looking at various things in isolation, because generally when you perform modeling, there is an interaction between the various assumptions. And we're cautious about going through and providing analysis on a single issue basis that we think should be looked at collectively through a process that determines the way in which these assumptions would potentially cause changes to other assumptions. So, I don't know, you've referred to our position as a favored position. I think that what we would say is that we have performed the work that we were asked to do. We have supported the conclusions that we have provided, and that we have done so in a manner that is sufficient. And I think that CICIBA can develop their own arguments. I don't necessarily agree with all of them, but I do believe that the best approach is to develop a study that is performed with stakeholder involvement, which incorporates answers to some of these questions.
And I'm not suggesting at all, Mr. Goody, that your report's not transparent. It was not thorough. I think it was all of those things. I am just suggesting that the approach that you or LEI was given in terms of not answering these questions, and you explained why just then, would put you in a position where you were treated one way, whereas if DESC had taken the same approach, we would have been treated vastly different. And we're going to come back to that independent report here in a second. So I want to switch, see if I can do this now. I want to switch now to, does your report come up on the screen now, Mr. Goody?
Yes, I can see it.
And Madam Chair, do you see the report?
Yes.
For LEI?
Yes, Mr. Willoughby, we see it, and if you could enlarge it a little bit, it would be helpful.
Let's see if I can. I don't want to jeopardize my lead for this technology award that I cultivated here. So to complete our discussion, Mr. Gooding, on transparency. You say, while LEI found DES to be highly responsive to interrogatories, in fact, you were complimentary of DESC for the speed and the thoroughness at which we responded to LEI's questions, correct?
That's correct.
And you have no concern at all about how quickly and how completely DESC answered your questions, correct?
That's correct.
But then you go forward and you say, however, transparency should be judged primarily on whether the application was presented in a way which minimizes the need for interrogatories in the first place. Minimizes the need for interrogatories in the first place. Now, I've been doing this a long time, Mr. Gooding, probably longer than just about anybody in this hearing. And I can promise you that there is no way that you can measure what is minimizing the need for interrogatories in the first place. Can you tell me what parameters you would put around that standard as you're thinking about it in your mind, writing that sentence?
Sure, and I appreciate it that each profession comes at things from a different perspective, and it wasn't my intention necessarily to develop an evidentiary standard that would go into a code. I think the current concerns that we had were that we felt that there were various assumptions and supporting logic or methodologies that ultimately interveners shouldn't necessarily need to ask about. I think you'll have heard me say earlier that I do see regulatory proceedings as an iterative process that in each one, everybody acting in good faith tries to do better than the previous one. So I think that what I would appreciate in reviewing a document like the application is to have a clear understanding of what are the underlying assumptions. Were scenarios used? What's the scenario analysis? How did that play out? Recognizing that, you're not going to be able to discuss 1,000 data files that went into a Plexos modeling exercise, right? That is a level of transparency that I think is beyond what a normal ratepayer would expect. But my concern is really that the filings be sufficiently complete that those that are reviewing them understand them, so that the types of questions that are asked are less about basic underlying assumptions and more focused on larger issues, so that we can get what was the gas price, what was the underlying load forecast, did this link up with the IRP? Those questions, I think, are probably things that if we craft the application in a particular way, those questions don't need to be asked. And so when we talked about minimizing, I think it was about being able then to move to the next level with regards to the nature of the questions, we didn't say that they should be that they should be eliminated entirely.
And I appreciate that response, Mr. Gooding, and, you know, I concur that the process is an iterative process, and it gets refined every time, and perhaps all of us go through the proceeding. But obviously, the commission will be looking at this proceeding, and will be, are you able to see my screen now where I have a statute put up, Mr. Gooding?
Yes.
And this is actually subsection J of 4120. Madam Chair, can you see this?
Yes, Mr. Willoughby, we can see it.
That even better?
That is even better, thank you.
So the statute says each electric utility's avoided cost filing must be reasonably, and the words are reasonably transparent. Let's see if I can highlight it. So that, and I've got a new, well, I just messed it up. Hold on 1 second, let's see if I can. Well, let's see. In any event, I'm going to stop sharing the screen. I may come back to it, but you understand the point, Mr. Gooding. We must be reasonably transparent in a file. And we're talking about this file. It's important the commission will be making a determination. Would you agree with me that in this file, that the information you had based upon the testimony you reviewed, the data responses that you evaluated, and some of those data responses were copies of what PSC had provided to other parties, and data responses that we provided to LEI, that using that information, you were able to determine the assumptions, the methodology, and the conclusions that Dominion Energy made in reaching its proposals for rates or avoided cost rates in this file.
I think, you know, my concern, I've been thinking about this as to where our differences lie in the definition of transparency, right? And I think about it from the standpoint of a window. So my definition is there's a window, I can look in, it's transparent, I can see what's in the room. What I hear as a position being put forth is that there's a curtain on the window, and as long as you ask that the curtain be removed, then the proceeding is transparent. Now, I tend to believe that that it may well be appropriate that there's some parts of the window that have a curtain over them, but I think that our kind of difference of opinion is how much of that window shouldn't have a curtain on it. And so I don't believe that, I'm not suggesting that your application should have resulted in no interrogatories from us. What I am suggesting is that there are some elements that I believe could have been put directly in the application that would have been useful for stakeholders, including those that are interested in and not participating directly, and that may have made the process more efficient. I am not suggesting, and I don't believe our report suggests, that there is anything that we asked for that we weren't given. But I think that the process could be more efficient if there were some of the information that is included directly in the application.
All right, thank you very much, Mr. Gooding. Let me now move to one of the conclusions that you came to. Let's see if let's see if I can share something else with you. And I want to talk about so I've got to click out of this. Let's see if I can, for some reason that is creating a problem. Bear with me one moment, Madam Chair. I have to do it another way. Let's see if I do this. No, neither of those work. So I'm just going to ask the questions. Mr. Gooding, you talked about some of the principles in your report that I want to go through with you, and I think the statute that we were looking at in this particular case, and we're talking about talking about 584120. I believe you made it very clear in your filing that one of the things that was very important is that ratepayers not be required to subsidize the activities of solar generators, correct?
Yes.
And in fact, the purpose of this proceeding is to determine the avoided costs of the utility, correct?
Correct.
And there's some subsidiary issues to that, but do you agree with me that the language of the statute says that any decision of the commission shall be just and reasonable to the ratepayers of the electric utility in the public interest, consistent with PURPA and Federal Energy Regulatory Commission's implementing regulations and orders, and non-discriminatory to small power producers, and shall strive to reduce the risk placed on the using and consuming public. Do you agree that that's verbatim out of the statute?
Yes.
And would you agree that in making your recommendations, you've tried to adhere to those principles?
Yes.
In fact, you put in your study, your consultant's report, you put those guiding principles in there as the things that would be critical for any decision maker. Those are the test that you're going to use to judge the information and evidence in this record, correct?
Yes.
Now, you made the recommendation, Mr. Burns talked with you a little bit about Mr. Burris's, Mr. Burgess's recommendation. But as we talk about the DIC as one of those items, the variable integration charge is of all of the people that have presented information in this proceeding, including your analysis, no one has done a modeling study like Guidehouse. Is that correct?
That's correct. However, I think that there's a few things that should be pointed out, which is that a modeling study in and of itself isn't truth, right? Just because somebody does a model doesn't necessarily mean that we should accept all of the outcomes verbatim. And I'm not intending that as a slam against Guidehouse or the applicant. You're absolutely correct that Guidehouse was the only one that did the study. Guidehouse was also given the time and resources to perform that. So I do have concerns about models being presented as truth rather than as a tool that we can use in conjunction with other tools to come to a conclusion.
Well, that's a very good point, Mr. Gooding. So the reality is then this, well, let me establish one thing. As you said, your recommendation of a independent study, and we'll talk about independent in a moment, was not in any way designed to denigrate or undermine or talk about the credibility of the report that Guidehouse has proposed, correct?
I think my focus is on the process. So in reviewing the Guidehouse report, I understand that they followed many of the types of processes that we would follow in performing the report. They did backcasting to understand whether their model could produce similar results to historical performance. So I believe that the results that they put forth are consistent with the assumptions that they put in. I think that what I've been recommending is that there are additional scenarios, that there be a set of assumptions that stakeholders work together to vet. I see a process that was described in the IRP that includes a set of advisory committees and so forth. I'm sure I'm not using the appropriate terms consistent with South Carolina practice, but and I think it would be worthwhile to have a process like that. We understand the modeling process very well, and what we're suggesting is not that is not to suggest that the Guidehouse study should be thrown out entirely, but rather that it should be used to think about how we would configure an independent collaborative process to develop something that integrates some different assumptions, that tests those assumptions, that looks at a few different scenarios that I think would provide a more comprehensive or a well-rounded view of what the variable integration charge should be.
So if you pulled everybody together into a room and said, here are the assumptions we're going to use, and let's say not everybody agrees to the assumptions you want to use, and not everybody agrees to the inputs. Do you think at the end of the day, when the study is completed, that there may still be disagreement about the results?
So I think that the approach has to include some testing of assumptions that you've otherwise rejected. Now, there's always going to be some people that say, look, you haven't gotten there yet. And I understand you've got to cut it off somewhere. But I also believe that if you show that the process incorporated some of these different assumptions, that you had a few different scenarios, that you thought a little bit about various peaker replacement programs and their influence on the VIC, just to give an example, that you'd be able to come up with something that attained a broader degree of acceptance.
And let's say you didn't get a broader degree of acceptance, Mr. Goody, we would be right back where we are now. We've got a study that people are challenging. We've got what do we do then?
Well, first of all, I would say if you did get there, it doesn't mean that you wasted your time, right? Ran an interactive stakeholder process. You involve folks at various key inflection points in the study. You demonstrate that you've assessed various assumptions and that you can show why you think they're immaterial. So you've built out the record in a way that provides more substantiation for the outcome. And so, I do think that it's certainly possible that you could do the exercise and come out with similar results. But there would be a broader acceptance of the process in the stakeholder community. And ultimately, when somebody comes up the next time and says, we're not getting solar built because you're charging us X for the VIC, you say, well, look, that's what it costs. And we've been through a process that involved more than the company hiring a consultant to come up with their own number.
And you just made a point that I think is a point that needs to be emphasized, is whatever it costs is whatever it costs, correct?
Yes, I think that it's again going back to cost causation, right? And so what we need, I think, a better understanding of is there are a set of costs that may have multiple causes. And, I think parties have noted in the Guidehouse study, there was the use of the word purely or solely, right? That in terms of building resources only to minimize the variable integration charge, there was, they didn't see the return. that ultimately the capital costs of those investments were going to be too high relative to the decline in the variable integration charge. But I do think that we need to look carefully at the word solely, and just make sure that there's no other value whatsoever to some of the activities that will be undertaken to reduce the VIC. Right? Should we necessarily be attributing all of those to integrating solar, or is some portion of the benefit for when you have an unexpected failure at an aging coal plant, or a single unit nuclear station faces a challenge? As we think about cost causation, have those scenarios been fully explored? So I agree, it costs what it costs, and every attempt should be made to avoid cross subsidies, but we also need to look at the way in which particular resources have multiple uses, and whether the cost of that resource is appropriately assigned 100% to solar integration.
But you would agree with me, as a matter of just looking at the principle of law that we are all bound by, in which the commission is required to make its decision. But the goal is to determine what the cost of integrating, in this case, we're talking about the variable integration charge, whatever the cost is going to be borne by someone. And the question that law says is that cost will be borne by the cost causer and not by the customer, correct?
So I never give legal opinions, but from the standpoint of regulatory economics, cost causation is an important principle. And the only area in which I would want to add a bit more nuance to what you said is that cost causation is not like sorting different sizes of screws into a toolbox. When you do that, it's clear that you've got a Phillips screw and it goes in that container, and you've got a round head screw and it goes into the other container. Cost causation, particularly when we look at ancillary services, we can look at ancillary services that are needed on a system over some time period. Some portion of those will be needed by solar this year, to integrate solar this year. Some portion next year may be needed to achieve other purposes. And so when we say it's straightforward from a legal perspective to say, the person that's causing the costs should pay the costs, right? And that's something that very few people will argue with. But in getting to the point of saying, well, which particular costs and how much are they, that's the area where it becomes a bit more difficult. And so we need to bear that in mind.
Well, and that answer would indicate to Mr. Gooding that the question, well, it's maybe straightforward to quote the language of the statute. What you just said is that it's a little more complicated, a little more complex to determine what the elements of cost are that make up avoided costs. Is that basically what your answer indicates?
Well, I'm focused on the variable integration charge in that particular answer.
Yeah.
I think with regards to the avoided cost, I would generally agree that it's complex, but in some ways it may be a less difficult question than cost causation than we've heard testimony about how the company is unable to develop an exact historical log of what variable integration costs were. And some of that is due to data collection limitations and so forth. But determining cost causation is in some ways more fraught than determining avoided costs, even though there are also certainly nuances with regards to determining avoided costs that we need to recognize.
So let's say, talk a little bit about some of the recommendations, and obviously there are many recommendations that we agree with. You report, list them. I won't go through them. It's there for everyone to review. But while we were talking about the BIC, let's stay with the BIC just one moment. You indicated that your recommendation would be consistent with Mr. Horry with an interim BIC at 96 cents per kilowatt hour would continue until subject to true up or down until this independent report was completed. Is that your primary recommendation?
That's correct. I think the units are different, I think it's 96 cents per megawatt hour, not per kilowatt.
No, you're exactly correct. It is megawatt hour. Forgive me for making that mistake. But your alternative recommendation was that if the commission believed it must fix a BIC in this case, is it the proposal made by Guidehouse and advanced by Green Energy South Carolina in this case of 180 for tranche 1 should be what would be your proposal, correct?
Yes, that's correct.
And for tranche 2, you didn't make a proposal. Would it be safe to assume that your proposal would be that 180 would be used for all tranches until the next case is done? Would you also agree that for tranche 2, that the 180 would be implemented subject to true up or down once the independent study was completed and we have the next avoided cost proceeding 2 years hence?
I think that if you were going to take that approach, you'd be better off just sticking with the 96 cents because it still puts you in the same, and again, I hesitate because, I mean, this is a legal issue with regards to what's the definition of fixed. But if I understand what you're suggesting, it's that, okay, we for all the ones that currently exist that have the true up, we put them at 180, they'd be fixed. All the tranche 1 would have 180, and that would be fixed for 10 years for the duration of their contract. Tranche 2 would be at 180 subject to true up. I think that just puts you back in the same circumstances. Again, understanding that I'm not making an economic argument here. And so I think if your concern is really, look, we want things to be trued up, and we think it's going to be a matter of 6 to 9 months that we're going to have that study done, depending on when we commence it and so forth, then you're better off setting it for everything based on that study than setting the 180 for the tranche 1 and setting it subject to true up for everything that's not in tranche 1.
Well, let me challenge that just 1 second. I mean,
of course,
you'd have 973 megawatts that you would have a firm, clear number that everybody could rely upon. So all you'd be looking at would be the incremental solar generators that came online above the 973 megawatts, correct?
That's my understanding of the way that tranche two is described, yes.
And so at least you would have a more limited number of folks or entities for which you would have to be expecting a true-up process, correct?
That's correct, yes.
Let's talk about, let's move away from Vic for a second and talk about avoided costs. You made a couple of recommendations about adjustments that you would recommend would be made to DES's calculation. One was the use of the ROCT cost assumption. Is that correct?
Yes, that's correct.
And I think you were proposing that the change case be based upon the ROCT cost assumption of a 66 megawatt unit as opposed to the 100 megawatt change case that's permitted by PURPA and that was used by Mr. Neely, correct?
Our concern is not with the specific size, right? Whether it's 66 or 100. Our concern is that the capacity change and the generating unit size be consistent. And so our view is that, you know, if you're using 100 for one, you should use 100 for the other. If you're using 66, you should use 66. So that was, ultimately, we're comfortable with picking, you know, any number within that range. It's just that we believe that the calculations should be performed consistently using a number that is equal in terms of the capacity change and the generating unit size.
Well, if Dominion Energy, South Carolina, and its predecessor has for 30 years used the 100 megawatt change case, wouldn't that be, and if we're talking about consistency, it would certainly be consistent to continue to use that change case, would it not?
Well, I'm slightly concerned that we're talking about different things, right? I am indifferent as to whether you use a 66 or 100 megawatt change case. What I'm concerned about is that when you go through the calculations and then you're dividing this out again, that you use the same number at the bottom that you were using at the top. That's our concern. We're not concerned with, you know, if you've been using the same number for 30 years, it's consistent with PURPA on the top line, we're fine with that.
So you could, if Mr. Neely testifies that Dominion Energy South Carolina and its predecessor has been using a 100 megawatt change case for, I said 20 to 30 years, he'll know better than me, but I think it's in that, I think that's right. And that he's consistently employed that change case for his avoided cost calculations, that would be acceptable to you.
I still think we're not talking about the same issue in the calculations. I don't have an issue with using a 100 megawatt change case. It's when you go further through the calculations and you start using an amount to divide out this number that the two should match. So I think that's where we have a difference of opinion.
And on the point, your recommendation of the ROCT cost assumption, if your recommendation is adopted, that would result in Dominion Energy's cost being increased, because that's a more expensive calculation, more expensive cost, and therefore what Dominion Energy pays to solar generators would likewise increase by commensurate amount, correct?
So our focus isn't on whether numbers go up or down. It's just about trying to get to what we believe is the appropriate avoided cost. You're right, directionally that's what happens. But that's not because we're trying to, raise compensation to anybody or lower compensation to anybody else. That's just the mathematical impact of the change.
And Mr. Gooding, I am not trying to suggest at all that there is a method to the recommendation, but I am trying to inform everybody of the direction and the impact of the decision. Do you know, as you sit here today, what the percentage amount of increase just that one recommendation would make in the avoided price?
Yes. So in figure 9 on page 37 of our report, we have delineated the impact of each change individually. And our intention in presenting this table is to allow the impacts to be assessed separately. And while we believe it's appropriate to apply them all, we also understand that parties may view the application of one or a combination as being more appropriate. And so in isolation, this matching the capacity change and generating unit size that we've been discussing has a 16.7% upward impact on the avoided capacity rate.
And if we look at another recommendation, the use or your recommendation to include the performance adjustment factor, which is pegged at 1.05%, how much of an increase in the avoided cost price does that cause?
5%.
5%.
Relative, taken in isolation, I should add.
Yes, correct, taken in isolation. And then if we go to another recommendation that you've made, the technology neutral rate and seasonal allocation, you would, how much would that change make standing alone?
Well, just to step back, we didn't see that as being an increase in the avoided cost rate. We just viewed that as being getting back to the view that the company has a single avoided cost in each hour. We just viewed that as being the appropriate way to apply the calculation. So we don't have a separate discussion of the implications of that.
Did you see Mr. Orby's testimony where he indicated that it would be at least 7% to make that change, and he disagreed with the change?
Yes.
And you do agree that solar alone without storage is highly variable, correct?
Yes.
And it's limited in hours. It only produces generation when the sun is shining, correct?
Yes, but the characteristics of the QF are not the basis on which we calculate the avoided costs. And so we completely agree that integration costs should be included in the variable integration charge. If, as the company's supplemental testimony argued, that there are additional costs that aren't in the BIC, I think we're of the view that they should be there. But our view is that the inflexibility of solar will already be effectively penalized by the fact that there's going to be hours that they can't show up for. Now, ideally, we want solar developers over time to be figuring out new technological solutions, whether it's the way that they place their panels or whatever they can come up with to kind of optimize their capabilities. But ultimately, what we're looking at is what are the avoided costs of the company, when is the need for the company, and if it turns out that solar doesn't show up in any of those hours, well, that's their problem, because we're not designing the avoided cost rates just to make sure that QFs make money.
And that's a very good point. In fact, the PERC orders say very clearly that financing is not a consideration for determining avoided costs. Whether a solar developer can finance or not is not one of the issues or one of the considerations, correct?
Is it okay that I answer? I noticed that there's some other heads that have popped up here, so.
Sure.
Yeah. Yes, that's correct. I think in all of the FERPA regulations, it's been clear that the intent is not, if states want to have policies that are focused on developing particular technologies or paying more than avoided costs, that's a separate policy decision that's different from PERPA. Right? PERPA just says we figure out what the avoided costs are for the utility. That's what we offer, and provided the avoided costs have been calculated through an appropriate process and are just and reasonable, then that's what you offer.
And in fact, that is the rate. Is as you would agree with me that solar is not going to be able to provide generation capacity at 6 o'clock in the wintertime when the greatest demand might be placed on Dominion Energy system, correct?
So I would agree that the solar production profiles don't match necessarily Dominion's need. And in terms of designing avoided cost rates, you should align them with the hours of need. And so if the capacity payment is in 3 hours when solar doesn't perform, that's not Dominion's concern. It's not a concern, I should say, not, again, trying to be pejorative with regards to Dominion. It's not a concern of PERPA. If we've identified the avoided costs and the time of need, and a resource can't provide, that's simply the way it is.
Well, in fact, you understand the underlying principle of PERPA is that QF, when they approach the utility and they provide generation, the utility must take that generation, correct?
Yes.
We do not have an option to say, no, we don't, except in very limited emergency sort of circumstances. So, and it's very true that most generation is going to happen at 1 o'clock on some July afternoon in the summertime when the sun is shining and everything is generated, right?
Yes.
But when the sun goes down, then Dominion Energy has to have other generation facilities in place to make sure that the system continues to operate reliably, correct?
That's correct.
And it's also true that it's got to have that generation in place on that coldest morning at 5 or 6 o'clock in the morning, in the wintertime, that it's got generation to supply all the needs of the firm customers in its system, or on its system. And we know that solar will not be providing any generation during those critical periods of time, right?
That's correct, and they obviously shouldn't be paid for it in that hour. If they're not, if the rate is designed to be an hourly capacity rate, that's only in the hours in which Dominion needs capacity, then if they don't show up, they're not going to be paid that rate.
Well, and of course, what we're trying to do is pay them for what they permit Dominion Energy South Carolina to avoid, what costs they permit them to avoid. And certainly you would agree that someone that's able to provide to Dominion Energy generation at 6 a.m. on a winter morning would be more valuable than solar generation that shows up at 10 o'clock on that same morning, right?
Madam Chair, I realize this is cross-examination, but we've let Mr. Willoughby testify for a little over an hour now, and I just wanted to lodge my objection that he's gone beyond cross-examination into testifying as to facts in the law several times. And I object to that question in particular.
Thank you, Mr. Burns. Mr. Willoughby, I understand that this is cross-examination, but let's rein it in a little bit if we could.
But I would say, Madam Chair, that Mr. Burns's objection is absolutely all it's saying is I don't like the conversation that's going on, and I'd like to put a stop to it.
Well, there have been a couple of times where I'd like to say, is there a question? But let's,
Thank you, Madam Chair.
Madam Chair, while we're on this point, would this be a time to take a break for the day?
you got a good bit more?
I've got a little bit more, yes, ma'am.
Is a little bit 10 minutes or 30 or an hour?
Yeah, a little more than 10, probably not an hour.
Okay. I think that I think it might be a good place to break, and I think our plan tomorrow is to start at 9 a.m. Is there any objection? I know that's a dangerous question. Hearing none, we will recess this afternoon and see y'all at 9 a.m. Thank you
very much, Madam Chair.
Have a good evening.